The other thing that I really think loan officers need to look at more, especially in today's market, is adjustable rate mortgages. I've talked about this a little bit on the podcast, but I want to go into it a little bit more because we've definitely seen a shift in really the last year, but even over the last few months where some of the 5 and 7 year ARM options look pretty good. And not just on I see Freddie Mac ARMs look pretty good. Obviously in the jumbo space, this has always been a thing in the non-conforming space, but even FHA, like FHA 5-1 ARMs. One of the great thing about ARMs is that when you do pay a little bit of discount, you get a lot of bang for your buck. Or if you're in a situation where a borrower is doing a large down payment, so maybe they're at a 70% loan to value as an example, and your loan level price adjustments, your LLPAs start going down because they have a high FICO score and they have a large down payment, that improvement in your LLPA makes a significant difference in what even the par interest rate is that you can offer on an ARM, because it's the same logic that applies to, paying points. Like any amount of adjustment to the fee on an ARM gives you more bang for your buck. Let me give you a quick example. I was just looking at rates today, and on a 30-year fixed, I think I did an 80% loan to value with like a 740 FICO. So not the perfect scenario, but rate was coming in around 6 3/8, 6 1/4, somewhere right in that neighborhood. And you could pay 2 points on that loan and get down to like 5 3/4 on a 30-year fixed. But on a 7/6 ARM, you could pay 1 point and you could get down to 5.625. So that same 1 point got you more than you would have got on a 30-year fixed for 2 points. And the break even on that was right around 24 months or so. If you looked at what the payment would have been on the 30-year fixed versus the 7-year ARM by paying 1 point on a $500,000 loan, you would have recovered that cost in about 24 months. So now the borrower has 7 years of a fixed interest rate. They've recouped their cost of their 1 point inside of the first 2 years, and then it's nothing but savings after that. And I think a lot of borrowers are not going to be in their mortgage for more than 7 years. So why not consider an option that gets them a much lower interest rate now? And look, I think we all agree rates very well could go lower in the next couple years. So you are kind of, making the guess that I'm not going to restructure this loan for about 2 years. And if you look at all the rate predictions, yeah, everything's looking like they're going to get better, but I don't think significantly better in the next 2 years. But, it could happen. And I think the risk is worth it.